You ever feel like the economy has a mind of its own? Speeding up one moment, then slamming on the brakes the next? Well, it turns out there's actually a driver behind the wheel, a powerful and often invisible force making these huge decisions that affect every single one of us. Today, we're going to peek behind the curtain and understand how it all works.
So, who is it, right? Who has their foot on the pedal, deciding if we're going to accelerate into a boom or slow down to try and avoid a crash? It's a simple question, but the answer is incredibly complex, and it really does impact your wallet, your job, and your future.
Okay, let's get right into it with our first section, the economy's driver. The one in charge of this massive vehicle we call the U.S. economy is the Federal Reserve.
Yep, that's it. The Federal Reserve System, or the Fed, as you've probably heard it called, it's the nation's central bank. Now, Congress created it, but it's designed to be this independent entity inside the government whose whole job is to navigate the twists and turns of our economic highway.
The main way they steer is with something called monetary policy. It sounds complicated, but the idea is actually pretty straightforward. It's just the Fed's decisions about the nation's money supply, and the whole goal? To moderate the economy. In other words, to keep the ride as smooth as possible for all of us.
And that gets us to their ultimate goal. You have to think of it like this constant balancing act. The Fed is trying to encourage economic growth, that's the expansion, without letting the economy get too hot. But at the same time, it's trying to prevent a recession or a contraction without stalling out the engine completely. It's an incredibly delicate job for sure.
So how in the world do they pull this off? Well, they have three main tools in their toolbox. First, they manage how much cash banks have to keep on hand. Second, they buy and sell government bonds. And third, they adjust interest rates. Let's break down how they use these tools to either hit the gas or pump the brakes.
All right, let's dive into Section 2, hitting the gas. This is what happens when the economy feels a little sluggish, a little slow, and the Fed decides it's time to light a fire under it and really encourage some growth.
The first lever they can pull is the reserve amount. Now, this is just the percentage of our deposits that banks are required to hold on to. They can't loan it out. So, to speed things up, the Fed cuts that requirement.
And what happens then? Well, if a bank has to keep less money locked away, it suddenly has way more money to lend out to people and to businesses. And more loans mean more spending, more investment, more economic activity. You can almost hear the engine starting to rev.
Okay, the second tool they use to hit the gas is buying up bonds on the open market. This one's a little more indirect, but believe me, it is incredibly powerful.
So here's how it works. The Fed literally buys bonds from banks, and in return, it gives those banks cash. All this new cash floods into the banking system, and that increases the overall money supply. With more cash just sitting there, banks are way more willing to lend, which makes getting credit easier and cheaper for everybody.
And that brings us to tool number 3, the one you've definitely heard about on the news, lowering interest rates. This is the big one.
And the reason it's such a big deal is because it directly encourages you, me, and big companies to take action. I mean, when borrowing money is cheaper, you're just more likely to take out that loan for a new car or a house or a business expansion. All that spending is the fuel that really drives economic growth.
But what about the flip side? What happens when the economy grows too fast and prices for everything start to skyrocket, what we call inflation? Well, that's when the Fed knows it needs to cool things down. And that brings us to Section 3, pumping the brakes. So, just as you'd probably guess, they use the exact same 3 tools, but they just throw them in reverse. First up, they can increase the reserve amounts that banks are required to hold.
By making banks keep more of their cash in the vault, the Fed pretty much shrinks the amount of money that's available to be loaned out. Fewer loans mean less spending, and that starts to slow the whole economy down.
Next, instead of buying bonds, the Fed starts selling them. They take the bonds they already own and sell them to banks on the open market. So when banks buy these bonds from the Fed, they have to use cash from their own reserves to do it. That cash is now effectively sucked out of the banking system and parked at the Fed. Less money in the system means banks start to tighten their lending standards, and that makes getting a loan a lot tougher.
And finally, we get to the move that always makes the headlines. The Fed raises interest rates.
Suddenly, everything from your credit card debt to your mortgage to big business loans gets more expensive. And when you're faced with higher borrowing costs, well, both regular people and big companies tend to pull back on spending and investing. And that acts like a powerful brake on the entire economy.
And this slide really puts it all together beautifully. It shows you the two sides of the same coin. On one side, you have the tools to encourage growth,
reduce reserves, buy bonds, and lower rates. And on the other side, you have the exact opposite actions to slow things down, increase reserves, sell bonds, and raise rates. It's a perfectly symmetrical toolkit for a world that is, well, often not so symmetrical.
Okay, so all of this might seem like some really high-level economic theory. But in our last section here, we're going to ask, why does this matter? Because all these decisions have a very, very real impact on all of us sitting right here in the passenger seat.
I mean, just think about it. That interest rate you pay on your car loan or your mortgage, yeah, that's directly influenced by the Fed. The job market? Well, when the Fed encourages growth, businesses hire more people. The price of your groceries? The Fed's fight against inflation directly hits your wallet. Even the value of your 401k is tied to the overall health of the economy that the Fed is trying to steer.
You know, it all leads to this one final crucial question. The Fed has these unbelievably powerful tools to steer the economy, to be its driver. But when you think about all the unexpected bumps in the road, from global pandemics to wars, is a perfectly smooth ride, a perfectly stable economy, is that even truly achievable? It's something to think about.